You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is founder and managing partner of Think Multifamily, Mark Kenny. Mark started his real estate career over 20 years ago and has extensive experience in property valuation, acquisition, and operations. He has a passion for helping others succeed in the multifamily arena. Mark is currently invested in more than 2,600 doors and has a top-notch reputation among the multifamily investment community, providing exceptional value to investors in the community while being easy to work with. Mark graduated from Michigan State University with a major in accounting. Mark also provided IT technical and business consulting for more than 20 years and is leveraging his vast IT experience to bring new creative technologies that will help others in the multifamily space. And so really in today's show, what I'd like to do is pull back the layers of Mark's business and take a look at the mechanics of how he's been able to build a significant multifamily business in just a few short years. But before we get on to the show with Mark, I just want to run through a few brief updates for you guys. First and foremost, Mark is in multifamily. That's his specialty. And for those that don't know, that maybe if you're just tuning in for the first time, we specialize in mobile home parks. That's our niche. And I'm telling you this because we are seeking mobile home parks to purchase. We're really in buying mode, and we're looking for opportunities, whether that be maybe a joint venture with you. Maybe you find a deal you can't take down on your own. You're looking for someone with a track record in the capital, one or the other, or both. We've got plenty of capital and plenty of a track record, and so we can help you take down a deal that's too big for you to do on your own, or maybe you've run across a deal and you're looking for a big fat finder's fee. We're really happy in paying big checks for the right opportunity. So if you run across a mobile home park that is 50 or 60 spaces in size or larger, and you think it seems like a decent deal, let's talk about it. So all you have to do is just shoot me an email directly. This is my personal email address, kevin@kevinbupp.com. We can handle deal sizes up to $25 million. It doesn't have to be one park. It could be a portfolio of 10 parks, okay? So we've got financing and we've got the track record to do it. Think of us when you come across an opportunity. We actually have two deals today that we're about to pay a total of $200,000 in referral fees on if they close. So that could be yours. You could be pocketing $200,000. How would that be? Pretty cool, right? Well, I'm ready to pay you. So bring us a deal and let's talk. Next up, I just want to give you guys an update regarding our mobile home park fund. If you're a regular listener to the show, then you know that we just recently closed out our first successful Reg D 506C offering, and we couldn't be happier with both the parks that we purchased as well as the many different investors that we've had the pleasure of partnering with. Unfortunately, with the good news, there was also some bad news. And what I mean by that is that there were a number of you that had shown an interest in partnering with us, but you weren't able to get into that first fund prior to us shutting the doors. But got some good news, and that is that me and the executive team here, we're working diligently on rolling out fund number 2. And so we expect to have that rolled out and ready to go sometime Q2. And so if you missed out on the first fund and have an interest in partnering with us in the second mobile home park fund, be sure to go to our website, sunrisecapitalinvestors.com, and create a free account inside our investment portal. And really what this will do is put you on our first to know basis. And so as soon as we go live with that second fund, you'll get an email from us, and you'll get first crack at it before anyone else does. So again, sunrisecapitalinvestors.com. It takes 5 minutes. Set up that free account in our portal, and we'll let you know as soon as we're ready to go live. Lastly, guys, if you happen to be in the Tampa Bay area, which is where I'm based, I'm over in Clearwater, Florida, which is maybe 25, 30 minutes from the Tampa Bay International Airport. I love meeting with others who share a passion for real estate. So it doesn't have to be mobile home parks, it can be multifamily or any other type of real estate, even if you're just brand new to the business. If you have some extra time while you're in town, I'd love to meet you. Maybe it's coffee, beer, lunch, whatever you might have time for. Let's see if we can get our schedules to coordinate. Shoot me an email, kevin@kevinbupp.com. Again, that's my personal email. Let me know when you're coming in town, and we'll try to get together. And so, guys, with that, I'd like to get on with our guest for today's show. So without further ado, let's welcome Mark Kenny to the show. Mark, how you doing today, bud?
I'm doing well, Kevin. How about you?
Oh, I'm doing fantastic. No complaints at all, my friend. So, Mark, we had the opportunity to meet very briefly,
Yes.
in the recent past out in Denver, cold Denver. I love Denver, but man, it was cold.
It was cold.
Yeah,
It was cold.
It was cold, and at Joe Fairless's best ever conference, which was a great time. I believe you were on a couple panels, right? Or maybe you moderated a couple panels. I don't know. I can't even keep track of what I did there.
We were sponsoring. We were one of the sponsors.
Yep. And so you were there sponsoring the event and partaking in all the activities, and it was a good time. So it was a pleasure spending a little bit of time with you. I didn't get to know too much about your business, and so that's why I'm really excited for today, Mark, to really dig into your business a little bit and peel back the curtains. And I think a lot of people really just lump multifamily investors all in like one category, but really it's much more than that. There's so many different variations of the business. And so I'd like to dive deep into what exactly your business looks like, the mechanics of it, how you've been able to grow it pretty significantly, or even just the past year. You guys have pretty much doubled in size. But before we get into the nitty gritty of it all, maybe take a few minutes, tell our listeners a little bit more about yourself, your background, and how you got into real estate.
Sure, absolutely. First, thanks for having me on the show, Kevin. I appreciate it. So I'm one of 7 kids, have an identical twin brother, grew up in cold Michigan. So Denver was too familiar to me. I didn't like it, actually. It's too cold. But, didn't have a lot growing up. I tell people I had pretty much everything I needed and nothing I wanted, kind of the way it was. And had a lot of somewhat embarrassing moments as a young kid. Just not having things like coats too small or clothes are too small. And people are way, way worse off than I was. But that kind of drove me at a pretty young age to kind of say, well, I never want my kids to kind of have the issue with, having things. Mm-hmm. And, I was petrified of asking my dad for money. It was just one of those things I just stopped asking him. So I really didn't know what I was going to do, but I ended up going to college, Michigan State University, for accounting, CPA for a little while as well. And said, I want to do something different. And I said, well, let's start looking at real estate. So my twin brother and I started looking at smaller properties, like 2, 3, 4 unit deals. Took my dad along with us on different property tours. And after, I don't even know how many, maybe 50 different tours, everything never made sense to my dad. Everything was a bad deal, right? But and I was 21. I had an accepted offer on a duplex. Drove back from college home and met my dad for lunch. My dad said, yeah, I don't think you should buy it. And I'm like, oh my goodness, it's an accepted offer and everything. So after that point in time, I was like, I'm just listening. I backed out of the deal. I mean, I was 21 at the time, and my dad, I respected him and still respect him. But end of the day, I kind of concluded I'm listening to the wrong guy because he's never bought a property. He's 80 years old now, still never bought a property. So my brother and I looked at some other properties, did not invite my dad. We bought a duplex that was complete rehab down to the studs, closed on the deal, and then told my dad that we bought it. That's how I got our first deal.
That's awesome. How do you take that? How do you take that news? Did he still criticize you, or what?
He's kind of a quiet guy, so he probably just walked off, shook his head, but he's supportive. But it was one of those things he was doing to try to protect me, but
yeah,
he's too risk adverse. I mean, just end of the day, and that's why he's where he's at today, and that's where I'm at today.
Sure.
And then I started doing, I mentioned as a CPA for a little while, and then jumped over, started doing IT consulting. I was buying smaller deals, 2, 3, 4 unit deals for several years, and some single family as well. Started my own IT company. Was doing really well with that. Had a lot of Fortune 500 companies as customers, and was working nonstop, sleeping about 3 hours a night, completely ignoring my wife, like in a bad way, to where it caused a lot of problems. And so about 4.5 years ago, probably, I had to make a decision: either keep doing what I'm doing and suffer the consequences, or do something differently. And that's why I decided to start buying larger multifamily properties and stop doing IT consulting.
Okay. And so, talk to me about that very first larger multifamily property. How many doors was it, and how long ago was it? And what'd you pay for it? Where'd you buy it? Give me all the particulars that we all want to know.
Sure. Yeah, it was in Mesquite, Texas, just in the Dallas area. It was actually a 32-unit deal, but the same seller had another 32-unit right next door, like right next to it. So and it was not marketed. The first one was, second one wasn't, but we ended up buying both of them for just about $4 million. Just shy of that, raised about $1 million in capital for that. It was mid-'80s construction, pretty good, probably B- ish type asset. Mm-hmm. And but it was through a broker. That's how we found it, a local broker. And it was a few years ago that we got that first one. And kind of it's gone well, but that one in particular, lesson learned there was, for me, we should have raised a little extra capital than we did. I've learned that lesson, right? But you want to raise more than you think you know. And there are a number of reasons why you want to do that, but I wish we would have raised a little more on that deal.
Was that just more so? Give me some of the particulars of exactly what you would have used that additional capital for. I mean, there's many different things that that additional capital go towards.
Right.
For that deal, where would it have helped?
I think that, there's a little bit of exterior work we still want to do in the interiors. We could have pushed rents further if we would have had the extra capital. We raised, a little bit extra than we needed, maybe 50 grand. But if we had another 50, we could have pushed rents even further and finished a couple of things in the exterior we want to do. It's gone up a lot in value, which is great. I mean, the market's been really kind to virtually everybody. Mm-hmm. But looking back on it, and now I know the other reasons too. A lender can come back at the end, right before closing, and say they need additional capital, and you might have to pay, contractors, even if you're going to get reimbursed from a lender. You just have to have the extra capital. And I think we should have raised an extra $50K on it.
Yeah.
Personally.
Okay. Is that the first time you actually raised capital for a deal?
It is. My brother and I did. We got a little bit from my sister here and there, but from outside family, yes, it was the first time raising capital.
Okay. And you did it in the form of a 506B or 506C type offering?
506B.
Okay.
So we allowed non-accredited investors in the deal.
Yep. So these were all pre-existing relationships, probably friends, family, co-workers, associates and such, right?
That's right. And we met people at different events and real estate events, and then having the IT background, a lot of the IT guys are interested in investing in real estate as well. But yeah, exactly what you just mentioned is kind of the process we followed. Okay.
Talk to me about the biggest learning experience of going from, I'm assuming prior to that, the 232 units, so 64 units total. Prior to that, was it just the duplex? Was that the largest multifamily that you owned, or?
Four units, so
okay,
still
so
residential, below 5 units. But yes, so with the biggest learning, I think it's just more of I would say there are a lot of complexities to it. Mm-hmm. I tell people it's not extremely difficult, but a lot of complexities because you're inheriting a lot of things when you take over the property, such as contracts, for example, or, if there are insurance claims, it's all tied to the property. The loans are completely different. It was non-recourse, but, figuring out that, hey, you have a 5 to 12 year balloon payment, whereas residential, typically you might have a 30-year payout, right? So we still got amortization of 30 years, but you do have that balloon payment. So financing is completely different the way it works. Mm-hmm. And then the biggest difference really from a overall perspective was really getting the idea that, with single family, you can only improve it enough to where it's going to be worth what the property next door is worth or the one on the block. Whereas when you go 5 and above, in this case, with 64 units, we could really drive the NOI up, so our net operating income through either increase in rents or decrease in expenses. And every dollar we do that for is, $15 of value. So that's the one thing I tell you. If you get that one concept, if you can increase your operating income, every dollar is going to be today $15 or more in value. So that was the biggest lesson learned, I would say, from going from smaller properties to bigger properties.
Okay.
And I found out it's actually easier. Actually, once you have the property, it was easier. I wasn't dealing with toilets and tenants and evictions and things like that. So that was a good positive. I wasn't having to do that anymore.
So that kind of, I guess that tells me that even from that first larger deal, the 64 units, you were outsourcing the management to a third-party firm. Is that correct?
Yes, we did. And that's another one. I don't really personally think 64 units is a great size, just my personal perspective. I think if you could get 100 and above, or pick a different number, if you want to say 80 and above, but 64, our payroll expense is higher because it's 64 units. Mm-hmm. We had a full-time person working there, which we don't really need them, but we kind of need them there for drive-by traffic and things like that. So, but yeah, I did not want to have to deal with, so we outsourced third-party management, and after going through what we went through with the smaller properties and knowing the hassles with that's not something that I care to do at all.
So what is the minimum size property now that you'll consider? Is it 100 doors?
For us, we typically don't look at anything less than 100 for properties. preferably 150 and above. But we also have a coaching program with students, and they will look at smaller properties, maybe 60 plus units. But I think there are better ways to structure it. Having a management company that specializes in the smaller properties is something that makes more sense. The one we use manages all our other properties, so we have a lot of properties in the Dallas area. And looking at that from that perspective, I think we're better off going with a company that actually specializes in those smaller properties.
Yep. So how did we find that? I mean, you mentioned like property management companies that specialize in bigger properties and specialize in smaller properties. Like, how do you determine, which has the strengths and which has the weaknesses for the different property types?
Yeah. So, I mean, just talking to people in the market that are using property management companies, we also talk to brokers and get their perspective. But I think lenders are probably one of the best sources to figure out which property management company should be used, because end of the day, the lender has more invested than anybody in the whole entire deal, typically.
Yeah, right.
So we've been places before where the lender be like, if you're going to do this deal, you're going to have to use this property management company. And it's because they have, they've vetted them, they know their experience. And we've gotten some really good recommendations from lenders about management companies. And then just going through questions, we have canned list of questions we go through as far as how many properties they own in the area and asset class and et cetera. I gave you a short example. We met with someone last week for a 104 unit deal. And they're telling us how, you don't need to have any on-site staff or anything like that. I said, that's that's cool, but that's unusual a little bit for 104 units. How do you get away with it? We're the only management company doing this. And I said, okay, well, what's the biggest property you manage? 12 units. And I'm like, come on, I was on with another partner. I texted immediately, said, let's get off the call.
Yeah. I mean, no more need to talk.
So there is a difference between those smaller properties and the larger properties, and vetting them out, and then being able to get on them initially and ride them a little bit. And if they're not performing, you might have to change management companies. We've had to do that in different cases, in the past, which is a big change, but you need to do it if you're going to have problems with them.
Yeah. Okay. What is the typical opportunity you guys are looking at today? I mean, are you playing in the value add space, or are you looking mostly for just stabilized deals that have already been improved? Or give me like your perfect deal, that fits all the boxes.
Yeah. We've done it all, down to the studs, rehabs, to things that maybe require $3,000 or $4,000 a unit rehab. The ones that require a lot of rehab are tougher. Yeah. They just are. There's more headaches. Yep. It takes more effort. Usually costs more than you think, and it takes more time than you think. But an increase in value can be a lot. So we're shying away a little bit from those big, huge value add deals, because a lot of those don't even cash flow day one.
Yeah.
So you're going to get interest reserves from the lender and things like that. So preferably a deal that already cash flows. I would like to have B minus, B plus, maybe even assets. The issue we run into is that some of the returns just aren't there.
Yeah.
But the headaches are less with those properties, and the physical attributes of it are better. We have a 1970 property with a chiller system. People know what chiller system it cools. So we have one central place that cools all 208 units. And last year in July, it went down for 3 weeks during July in Texas. So that's a physical attribute of an older building, right? That really wasn't great. So we did everything we could to get it back up, but we had a part that had to be ordered, and we couldn't get it sooner, and everything is kind of a fiasco.
I don't want to move on yet. I want to talk about that, because that and it doesn't matter if you have I think a lot of people that aren't in this space yet, and it doesn't matter what kind of real estate you end up owning, but I think a lot of people think that haven't owned real estate before, whether you're self-managing or have a third-party management company, in their mind they think, well, that's not really that big of a deal, because Mark doesn't even have to deal with it anyway. It's a third-party management company. It's going to be getting the calls, and they're going to be dealing with all the irate tenants. But that is a majorly stressful situation. There's a lot of risk associated with it. And I don't know how your leases are written, but there could be tenants that maybe are, month to month that aren't in a lease, that maybe have an out based on a clause in the lease. If there's something that isn't repaired, or tenants or the landlord's not addressing a repair, that they can, get out of their lease. And so, they just pack up and leave anyway. They don't care.
Oh, that's what happens, right? They pack up and leave.
Yeah,
that's exactly right.
I'm not having my kids sit in this 100-degree apartment. We're gone. We're going to go to the next place down the road.
Yeah. And you have the other issue that, yes, the third-party management company is dealing with the tenants, but then we have the city involved, right? So the city's coming in, and then Section 8, we have some Section 8, about maybe 12% there at the property, and they're not letting people move in because of it. So it can spiral out of control. So that's why really knowing your criteria is really important.
And there's no temporary solution to that. So we recently, we have a park in Alabama, and, the Southeast, I think it was about a month ago, got some, abnormally cold weather. Alabama very rarely gets below freezing, and they were like near the single digits for like 4 days in a row, 4 or 5 days in a row. And the infrastructure in that park is not built as such that it would be if it was in Michigan. The water lines and all that, they aren't buried 4 feet in the ground; they're buried a foot below, and which is the frost line when it's 9 degrees outside for 5 days in a row. It's there, and it's hitting the water. We had the main water line freeze in this entire community. It's never happened before. It was that cold to where the entire, even with the flowing water, it froze. And luckily it's a smaller community. It's only 68 homes that are in there. But even then, thankfully there was a solution. If it was power, it'd have been a different thing. But our solution was we literally went and bought I don't know how many cases of water for each family, and literally just kept them stacked at the office, and they could come by. And so they had drinking water to brush their teeth. They couldn't shower with bottled water, but but it still gave them the bare necessities. And so that was a solution for us, and people, they dealt with it and they're okay. But not having air conditioning in Texas in July, there's not really, for however many, I don't know how many people are in this unit, but
208 units.
Oh,
but the solution really is to get some window units.
How many? Well, you get 208 of them?
Yeah, no, you do. And, so sitting there making a decision like, well, hey, do I spend that kind of money doing that? Yes or no? You need to do it, so, but it wasn't a good situation.
Did you do that?
Problem.
Did you buy?
We did.
You bought 208 window units.
Some of them actually would still cool. And the back building was still cooling, because of the way the pipes are working, but the rest weren't. So we had to buy a bunch of window units. That's why I tell people, understanding the characteristics of the building. Flat roofs, for example, do you like it or not? Do you want it? Will you do it? It'll help you kind of weed out those deals that maybe you're not interested in.
Is that grounds, a situation like that, is that grounds for an insurance claim of any sort? Or is that directly?
It's not. Yeah. This one's not. You can get insurance for mechanical. This doesn't have. This was not for.
Wow. Well, I'm sorry, but that sounds like a nightmare situation. So you made it through? Yeah, you made it through. But that's a part of owning real estate. It's not everything's pretty, but it's just all about how you handle the situations. And the slumlords are the one that literally would have let their tenants sweat, and they probably wouldn't even fixed it in 3 weeks. It'd have been like 3 months.
Wait till summer's over.
That's right. So, well, good deal. Well, so talk to me today about the markets you guys are in. I know that when we were discussing, or a short period of time we were talking there at the conference, you got a good bit of properties there in the Dallas-Fort Worth area, but you said that you're starting to not necessarily move out of that area, but move your focus for future opportunities, and you're starting to look really hard in Atlanta. I know you got some number of properties in contract today, but talk to me about why you're starting to divert your focus away from Dallas-Fort Worth, and why you like Atlanta, and if there's any other markets that you like as well. What are the reasonings?
Yeah, I love the Dallas market, but the problem is everyone else does as well.
Yeah.
And the cap rates are getting very compressed here. And for us to make the returns that our investors want, we're not really finding deals here that do that. I'm not saying they don't exist, but the amount of effort you have to go through to find those. We haven't bought in Dallas for about 16 months. Started buying in Atlanta. Personally, because I think Atlanta and Dallas are pretty similar. Atlanta got hit really, really hard, though, in 08 and 09, but they made a lot of adjustments. And there's a lot of population growth there and job growth and things like that. So I think, Atlanta still has a lot of upside, in my personal opinion. Cap rates are more favorable than Dallas. And I just think they're behind Dallas, where Dallas was a few years ago.
Give me an apples to apples comparison. Similar facility, similar market location as far as cap rates are concerned.
Dallas will vary quite a bit, but I'd say if let's say Dallas is 5.5, 6, it's going to be 6, 6.5. So it's not drastically different.
Yeah,
but maybe half a point.
Okay.
In some cases, but that's not really the main difference. It's that there are still a lot of value add deals in Atlanta. That's the main difference. Meaning, in Dallas, we could get them a few years ago, come in, rehab them, put whatever, $5,000 a door in, bump rents up. Most of those deals are gone in Dallas, but a lot of them still exist in Atlanta, and a lot of the deals in Atlanta are still self-managed. So Dallas is very sophisticated in my mind as far as the way properties are run. So if you think you're going to come into a deal in Dallas and just cut expenses, maybe, but likely not. Maybe because your property tax is going to go up and things like that. So this notion you're going to come in and just run it a lot more efficiently. A lot of properties here in Dallas are run very efficiently. Mm-hmm. Atlanta, they're not. A lot of them are not run very well. So we can still find those deals where they're mismanaged or self-managed, and go in there and make those improvements. So even though the cap rates aren't drastically different, some of the attributes of the value add deals that still exist in Atlanta don't exist in Dallas.
Got it.
And then we're buying in Memphis as well for cash flow. There's some incentives there from a tax perspective, property tax perspective, to buy there and improve the property. So that's getting used now. You can actually cut your property taxes by 50%. And freeze them for 10 years.
Wow.
So huge. There's some things that have to happen in order for you to do that. You have to infuse capital, but that's where you can really get your cash flow really going with your property taxes. That's really your biggest line item.
Yeah, no, absolutely.
Expenses.
Okay. I'm assuming finding deals for you guys, is it primarily brokers that you're relying on for these opportunities?
It is. And
okay.
we get some other deals sent to us from other sources, but primarily it is brokers. And I know people will be like, well, if the deal's listed, it won't make sense and things like that. That's not always true. Mm-hmm. I think getting the broker relationships and getting some off-market deals, it doesn't mean every off-market deal is a killer deal, because they're not.
Yeah.
But less competition and getting the broker relationships where they know what we want, they'll contact and say, this is really a deal you should look at. And they'll tell me that versus me looking at every deal that's on the market.
Sure. Talk to me a little bit about the broker relationship. I know that, and you coach new multifamily investors and getting into this niche. And I know one of the biggest challenges, and it doesn't matter if you're buying apartments or shopping centers or office buildings, but if you're going to be relying on that broker relationship, which is very powerful in commercial real estate in general, it's hard. It's a hard hurdle to get through when you're first getting started to, number one, have the brokers that actually have those relationships put you on the priority list. Call it whatever, whatever the priority list, the black. I don't know whatever the list is. I mean, it's the list that you want to be on, so that they think of you when an opportunity comes along. What do you teach your students on how to get through that hurdle? Because I think it's challenging, and I think it's discouraging for a lot of people that are trying to get into it, especially when they can't get callbacks or they got brokers that are just sending them kind of like the trash deals, like the LoopNet deals, the trash can deals. How do they do it? Yeah.
So for us, it's funny because my wife Tamil and I actually did a video on this topic that you just mentioned, and for us, if a deal makes sense, so someone in a group proposes a deal to us and it makes sense and we think it's a good deal, they can partner with us. So they can use, hey, my partners and I. So I said the four most important words for a newbie are my partners and I own whatever, 2,500 units, things like that. So when they call brokers in, let's say the areas we're invested in, and they say, hey, I'm hooked up with Mark and Tim Kenny, think multifamily, they get the credibility just because they're associated with us. It's that partnership type deal. If they're going to a brand new market, then, and the broker doesn't even know us, they can still use a story, track record. My partners and I own 2,500 units, whatever number is, did 6 deals last year, raised, X millions of dollars. So it kind of gives the credibility versus someone just calling out of the blue and saying, hey, I'm new and I'm looking for a deal. Mm-hmm. So whether, if you're going to start new, people are like, hey, I'm going to do everything on my own. Chances are you're not going to get a deal unless you're going to overpay for it. because a broker can't go to their seller in any confidence and tell them, hey, I think Kevin can close, even though Kevin's never closed a deal before.
Yeah.
It's not going to, versus, hey, Kevin's done X number of deals before and you get a reputation of closing deals. That's critical for a seller, because it's not like a single family where you close really, really fast. Some of these deals can go on for, sometimes several months.
Yeah.
So for a seller to have to start over again, they really want to know you can close a deal.
Yeah.
So that's what we tell them. You need to leverage somebody else's story if you don't have one. That's the key.
Yeah, and the brokers don't get paid unless the deal closes. So the brokers and the sellers,
everyone's upset with you.
Absolutely,
exactly.
Absolutely. And there's lots of money, lots of money and time tied up in as well once you get to that point. So, talk to me about the funding side of this business. I know you guys raise equity to do your deals. I'm assuming lots of the funding comes from agency debt. Is that an accurate statement? It
is. Yeah, we raise money. We've done Fannie, Freddie. We've done a number of bridge loans as well. So we get some of the bridge loans are very attractive now. You get 85%. In some cases, loan to cost includes your rehab, includes 3% of closing costs. So there's some really attractive loans out there. But we've done Fannie Mae, Freddie Mac. We've done small business balance. We've done large deals, and we started down a HUD path as well. I don't think we're going to go down that path, but we started down that as well.
I heard that's very challenging time-wise to get those HUD deals done. Is that the case?
It is, but they have a kind of a bridge to HUD program. So you get the bridge, and it'll take you probably 9 months to get the HUD. But there's some other reasons why I probably won't go down that path. There's definitely a lot of advantages to it, and there are a number of disadvantages to it.
What are the advantages to the HUD program versus a normal agency loan?
Yeah, you'll get like 35 years. If it's not development but an existing property, you get 35% fixed amortization. So fixed, and then you'll get typically a lower rate. You do have PMI, but the lower rate will definitely be there. You get up to 85% loan to cost.
Wow.
So everything is higher leverage, interest rates lower, and it's but then it's a 10-year prepayment penalty. Goes down 1% per year, and then your reserves are typically, so negative is your replacement reserves are typically higher. They can be $500-$600 versus $250 to $300 per unit per year. And then you can only do distributions every 6 months.
Wow.
So, and they just have a lot of clout. They can come in and inspect and make you do things and make you do more things than a normal lender would make you do. So,
is there a balloon period, or does it fully amortize out? Really? Wow.
No, yeah, there's no balloon. So that's attractive.
Are they assumable after that 10-year, after that prepay burns out?
They are.
Okay.
They're assumable even before the 10. Okay. You do have the prepayment penalty, and so yeah.
Interesting. Have you found that a lot of people have had success with that program?
I think people that do them really love them.
Okay.
I think people that have never done them are scared of them.
Right. Makes sense.
But yeah, they're like I said, there are definitely advantages, but there are disadvantages. So it needs to be the right asset.
Got it. So I want to talk to you about the equity side of your business. What have you found to be the attributing factors to your success, being able to raise tens of millions of dollars over the last couple of years? Where are you finding investors? Did you already have an existing network that you plugged into, or have you built a substantial network over the years just from doing deals? I mean, give us an idea. Again, that's another one of the big challenges I think a lot of new people face when they get into this business. And again, a lot of your students probably go through the same challenges. They got you to kind of they can lean on your shoulder a little bit. I'm assuming if they find a good deal, you'll help direct them down that path. But for those that are just listening in, if they're not part of your program, they're out there looking at deals, what advice would you give them as far as raising capital for their first deal? What would be a good ramp up approach to help them overcome that hurdle?
Yeah, I would say being hooked up with somebody will definitely help, someone's track record. But if they're going to go out and try to build relationships, I would say spend the time building the relationships and less time asking people for money.
Yeah.
So if you can actually build the relationships and you understand what the person wants, maybe you don't have the solution. I refer people all the time to other people on a regular basis because maybe I don't have what they're looking for. But understanding this connection, I did IT, and I also was a CPA. So my skill set wasn't, I didn't really care necessarily about, tell me about your family. I just, that wasn't my in my job description, basically. I was there to fix problems. So it was a big learning difference for me, but I have found that I've built so many relationships now with people, not just business, but also through friendships and understanding what makes someone tick. People love talking about the kids, for example, right? Or people will say, you know, one guy, I heard some so-called guru was like, at an event saying, oh, people here talk about baseball. This is a real estate event. I'm like, maybe they like baseball. Yeah. I mean, that's connection. You want to connect with my son? You talk about motorcycles. He'll talk to you 24 hours a day. Connect with my daughter, it's dancing.
Yeah. So
getting those common things, or someone would say, hey, I know I went to Michigan State, or I have a twin brother, or whatever it might be. The more connection points you can have with somebody, it's subtle, right? The more apt someone's going to be interested. I had people call me and say, the only reason I called is because you went to this school. The only reason I called you because you did IT. So getting people connected that way, and just understanding it you need to be patient. It'll take a long time to do it. And you need to be, open to basically listening to people, and that maybe you don't have the answer for them yet.
Tell me if you've had the same experience as far as building relationships with investors. I've come to find, and at least in our company here, that we're much deeper than we are wide. And what that means is we've done really well with a core group, what we consider to be the core group of our investors. And what we found is that we've treated them well, but we've also given them we've given them the returns, and we've given them we've hit projections. We basically met their expectations that we set. And what happens is you find that people will tend to brag or tell their friends, or, a guy on the golf course hanging out, he's getting, 14, 16% in his money, and his other buddies are getting like 2 and 3%. And he's gonna, he's the cool guy. He's definitely going to say something, and they're going to want a piece of it. So have you found that to be a similar scenario, that you're much deeper than you are wide with your investor base? We are. A lot of repeat investors, and like you said, people would be like, well, it's okay if I tell somebody about you? I'm like, yes, sure. It's okay. Please do. And we have our own meetups that we do too, that kind of helps build, people will show up and they'll be like, hey, I've been watching you for the last 6 months or a year, where it might be. And then they show up at our events. We do events. So just realizing it takes that time. And like you said, if you treat people the right way, then they'll start telling other people. Yeah. Right. Talk to me about the meetup event. I want to hear about that. I want to hear how long ago you started it. Is it a monthly event? And, what kind of success have you had because of it?
Yeah, we have 2 in the Dallas area. There's one a month, so twice a month, right, between the 2 of them. We've had a lot of new people just show up, and we've gotten people from there to invest with us. We've gotten people that have joined our program from there. There's a little bit of work to put on, but nothing like putting an event on. We put, 3 2-day events a year, plus some additional events we do in a year, like a deal analysis class we're doing, to 1 day just deal analysis. So being looked at as the expert in providing value to people, we'll bring experts in different areas too to help people and train them and teach them. It gives you that kind of credibility with people, is what we found.
Yeah, no, that's very cool. And how long have you been doing the meetup?
I think about a year, somewhere around a year. Okay. And then the events we've been doing, we've done 5 so far. We have 3 this year, plus in addition about 3 one-day events we're doing. So we'll have 6 events or more this year.
What do you find on average? How many attendees come to those free meetup groups?
It'll vary. We might have literally 100 people saying they're going to come, and 55 show up. So usually we find that lots of times it might only be 50 to 60% of the people say they're going to come actually show up because it's free. It's just the way it is. There's a lot of meetups in the Dallas area for multifamily, so it's a little bit harder. Okay. Yeah. I think we probably have 1,100 people on our meetup that are registered in a meetup, and then we'll have 30 to 60 show up.
Okay. No, where I'm going with that is I know Joe Fairless speaks a lot to this, and I always suggest those that are new, whether you're new or have some experience, it doesn't really matter either way, but how much value there is in starting a meetup group, right? It's really inexpensive to do. Meetup.com is a powerful, powerful platform. It is. just getting out there. It doesn't have to be expensive. You don't have to think it's going to cost you a lot of money. I don't know what Meetup costs, maybe $15-20 a month. It's not very expensive. And then your venue, so you could probably go to your local library and actually get a free room for 20 people, or maybe a local college or something like that. You might not even have to spend money if you get creative with it as far as where your meeting venue is going to be. But, it's a great way to really position yourself as a thought leader. Even if you're not the guy, even if you don't have experience yet, go start a meetup and then call Mark and say, hey, you want to come speak at my meetup group? That's
exactly the way to do it. It is. Yeah. It really is. Yeah. And you can do it. We do it at restaurants. So we typically do it at restaurants that will have separate bills for each person. So not all will do that, right? But you want that. And you typically want to go to a restaurant that doesn't have a minimum. Some of the restaurants have $250 or $500 minimum. If you start a meetup and 2 people show up, you don't want to have anything like that, right? And we all tell people when you're going to do meetup, actually let it season a little bit before you actually have your first meetup. So start it, you start getting people interested, people joining your meetup online, and then have your meetup when you have a certain number of mass in there. Don't have like 5 people or 10 people in there and go do a meetup. Yeah. I don't suggest you do that. You want to get a little bit more. People won't come back. They don't come back, right?
Is there a secret that you found when you first started your meetup group to grow it quickly? I mean, is there any like ninja strategies where you go and like start inviting people from other meetup groups that you're a member of or anything like that?
No, I'm trying to think when we first started them, I think we just sent it to our email list and we put it on social media that way. But you could probably see other people in there from other meetups and like you said, see, hey, there's someone's in a real estate one, but it's just basically word of mouth, and social media has been good though. Really been good to get that built up.
Even Meetup itself is really good. I've had many Meetup groups over the years. We've been using Meetup probably for 10 years or more. I mean, back when it was in its infancy, and even then, it's a powerful medium. I mean, like it essentially it's really good with choosing. You got to select your keywords when you start your group, but it's really good about finding others that have utilized those same keywords that are members of other groups and blasting out to them when you're ready to launch your group. And so I've found that we've gained a lot of traction and we've had many non-real estate related meetup groups, running clubs and different types of things like that we've had a ton of success in. And Meetup's a very powerful platform, bottom line. And so my suggestion for those that are out there, if you want to get out there and start positioning yourself as that thought leader and meeting others, you create the venue for networking. If you're not the guy that likes going out and trying to network at different events, create your own. Then let the people come to you and facilitate it. So,
and you don't even need to have a guest every time. We have every 4th one. We'll have it networking only. There's no topic. Just come there and meet people and do that. People like that as well. So, like you said, don't get scared because maybe you're a newbie. People will appreciate you putting it together.
Yeah, absolutely. So, Mark, you've been doing this for quite some time now. I want to ask you the question of if you can go back and give younger Mark, some advice when Mark was just first getting started, knowing what you know today, what advice would that be?
So people, I think there's a Russian, proverb is trust but verify. Mm-hmm. I would reverse that probably. I would say verify and be very slow to trust. And I'm not trying to be cynical about it, but there are a lot of people out there in the business that you really need to be careful about and making sure you do your due diligence, get everything in writing. I think is probably one of the key things. I can go through a whole story over stories around things that should have been in writing that weren't. So that's critical.
Okay, fantastic. That's great advice. And Mark, now we're going to enter into what we like to call the golden nugget segment of the show. And this is where we're going to kind of wrap things up for the day. I want to be respectful of your time. If you had one final golden nugget of advice left to give, and you've given a bunch already today, that may offer wisdom to our listeners, that may inspire and motivate them as they progress in a real estate investing career, what would that one last golden nugget be? And this could be, there's no right or wrong answer here, maybe some core values or success principles that you live by, but what would that one last golden nugget be?
Probably have a number. If I said one, I'd say maybe get really, really good at something. Mm-hmm. Know a lot of things, but get really, really good at something. So if you're really good at analyzing deals, people will be attracted to you, and you have to provide value if you're new. Mm-hmm. If you can't provide any value to somebody, the fact is they're not going to want to necessarily interact with you. So if you're not good with numbers, but you can actually be good with people, then maybe you can raise capital or build relationships with brokers. So get really, really good at one thing.
Yeah, no, that's great advice. Well, Mark, this has been a lot of fun. I really appreciate you coming on the show today. And for those that are out there listening and want to learn more about Mark and his company and the different resources he offers, and as he had mentioned, he offers multiple training events a year, and he's got a multifamily training program. They can go visit him at thinkmultifamily.com. That's think, THINK, multifamily.com. And Mark, that's all we have, my friend. I really, really appreciate you coming on the show, and look forward to following your success. And until
thank you for having me, Kevin.
Until next time, bud. Keep kicking butt, and we'll talk again sometime soon. Okay, you take care.
You too. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.